Hi there. In this explainer video, we're going to answer the frequently asked question of what is the difference between a traditional IRA and a Roth IRA? Now, in terms of self-directed IRA, know that that is merely an industry term. It just indicates that you have the ability to invest at your own discretion and self-direct into assets beyond just the traditional financial markets. Now, keep in mind that some financial institutions will allow you to self-direct, but you may only be able to self-direct into public securities like stocks and mutual funds. So you want to look for a firm that'll allow you to self-direct into alternative investments like real estate, as well as in the public markets. That being said, what's the difference between a traditional and Roth IRA? Let's jump into it. Important to understand that you either pay taxes on the seed or you pay taxes on the crop. So just remember that analogy as we progress throughout this short explainer video. So let's start with the traditional IRA. Traditional IRA, think tax-deferred growth. Think when you make contributions to a traditional IRA, you get a tax deduction. Now, you will learn that there are some instances where when you make a contribution to a traditional IRA, depending on your income and your participation in an employer plan, that you don't get a deduction. These are known as non-deductible IRA contributions. But for all intents and purposes, when you make contributions to a traditional IRA, you get a tax deduction. It grows tax deferred. And then when you take money out of the traditional IRA, you have to pay taxes. So because you didn't pay taxes on the seed, you have to pay taxes on the crop. So quick example for you. Let's say you start with $6,000 today. And let's say over 30 years, you grow the traditional IRA to $1 million. And then let's say at 59 and a half, so 59 and a half is the qualified retirement age in the United States. 59 and a half is the age that permits you to distribute funds from your retirement plan without any penalty. If you take money out prior to 59 and a half, there's what's known as a 10% premature withdrawal penalty. So at 59 and a half, let's say we take $100,000 from the traditional IRA as a withdrawal. We're not taking it out for investing purposes. Let's just assume we're going to distribute the money for our own personal use. That's called a distribution. This $100,000 is added to our ordinary income, and then we're going to pay taxes accordingly. So let's say our effective tax rate is 20%. 20% of $100,000 is $20,000. So we keep $80,000, and then $20,000 must be paid in the form of taxes. So that's the way tax-deferred growth works. Tax-deferred meaning in each incremental year, as we're growing the traditional IRA, so as we're investing in real estate, notes, mortgages, private equity, gold and silver, cryptocurrency, whatever it is that we're doing, or investing in the public markets, as we achieve growth through dividends, through rental income, through the gains of sale of assets, we have no taxes. We don't pay taxes till we take the money out. So from a compounding interest perspective, traditional IRAs can certainly be considered to be in a tax-favored environment. That being said, you'll learn now with the Roth IRA, you could potentially put yourself into a position where you pay 0% taxes on any of your distributions. So let's use the same example. We have $6,000 that we start with, and let's say we grow that to $1 million. And at 59 and a half, let's assume in the same example, we want to take a $100,000 distribution. We would pay 0% tax. So as long as we're following all of the rules, we wait till we're 59 and a half. You'll also learn there's what's called a 5-year seasoning period on a Roth IRA, which means you have to have the account in existence for 5 years. So as long as we follow all of the rules, when we take a distribution, we pay 0% tax. And keep in mind, the $1 million, let's say we have in this Roth IRA, we could take a distribution of that entire $1 million, and that $1 million is not added to our ordinary income, so it doesn't impact our tax basis, and we pay 0% tax on the distribution. Compounding interest in the absence of taxation is what we like to refer to this as, and it can be incredibly powerful. And a lot of alternative investment investors will be very attracted to the Roth IRA if they feel strongly they can make a high rate of return on their investments. You'll also learn about folks utilizing Roth IRAs from an estate planning perspective, leaving their Roth IRAs to their children or grandchildren in a tax-free capacity. Last but not least, it's important to understand that you can convert traditional IRA money into a Roth IRA. This is known as a Roth conversion. So for example, let's say we want to take $100,000 and convert it over into a Roth IRA. Again, this is called a Roth conversion. Think of it this way, using our seed and crop analogy, it would be as if you had crop that was 2 feet high and 10 feet wide, and you felt strongly that you could grow it to, let's say, 20 feet high and 50 rows wide. You might say it makes more sense for me to pay the taxes on the smaller stalk than the much larger crop. So you can get the taxes out of the way now. So we convert 100,000 over into the Roth IRA. And let's say at that time, we're at a 20% effective tax rate environment. 20% of 100,000 is $20,000. So we pay $20,000 in taxes in order to move that $100,000 into the Roth IRA. Now, we do have other explainer videos and content, all specific to Roth IRA conversions, backdoor Roth IRAs if you're over the MAGI limit. So you can check that video content out at another time. I hope you got a lot out of this training on the difference between a traditional IRA and Roth IRA, as well as the Roth conversion. Until the next explainer video, keep leveraging compounding interest in the absence of taxation.